Hey, welcome back. It's Jason Walter here. In today's video, I want to discuss foreclosures in the US because I've been seeing a lot of people on my channel commenting that foreclosures spiked greatly in January. However, what happened in February? So that's the topic of today's video. I'm going to be giving you a latest update regarding this, and also I'm going to be sharing how negative equity has changed over the years. In addition to that, I'm also going to be sharing how each of the states fares as well, because some states have a higher share of negative equity, whereas others have a low amount of negative equity. And of course, that could drive foreclosures if a lot of people have negative equity, right? Anyways, let's go ahead and dive into the video here. This is according to Black Knight. If you're not familiar with Black Knight is a data analytics firm that supports the real estate and mortgage industry. They have a really good website. They provided a lot of detail regarding forbearances over the years. So I've been looking at their data on a monthly basis here, but I want to share this report here. So this is for March 24th. In this report, they say even though that past due loans for mortgages edged higher by 1.8% in February, the national delinquency rate still remains near pre-pandemic levels heading into March. So we're still at very low levels compared to pre-COVID though. February's increase was driven by a rise of 97,000 in early stage delinquencies, which nevertheless remain well below pre-pandemic levels. However, it does vary by the state in the US though, so let me share some data with you here in just a little bit. At the same time, the number of seriously delinquent mortgages, and those where people are 90 days or more past due, those fell by 72,000 as borrowers who left forbearance plans continued to return to make their payments. So people that have entered into forbearance plans, they are starting to make their payments again, and that's causing the number of people who are seriously delinquent on their loans to fall by 72,000 people. After seeing a sizable spike in January, and this is what you guys have been commenting on, where we see this big increase in foreclosures, after seeing that big spike in January though, foreclosure starts pulled back by 24% in February, dropping 25% below February 2020 levels prior to the onset of the pandemic-related crisis. So even though we saw a spike in January, the amount of foreclosure starts pulled back greatly by 24% in February. It goes on to say that even though we have a 39,000 increase in the number of loans in active foreclosure, the population of people in foreclosure remains 32% below February 2020 levels. In other words, pre-COVID, we're at 32% below February's levels here. So I have a report to share regarding negative equity in the US and also how that varies by the state and also by the city. But let's first go over the top 5 states that have the highest non-current percentage, meaning the highest percentage of people who are not current on their mortgages. So Mississippi led the pack with 6.96%. That's the total percentage of people who are not current on their mortgages in Mississippi. So 7% of all people who have mortgages there are not current on their mortgages. Louisiana, West Virginia, Alabama, and Oklahoma led the pack after that as well. In contrast, here's a look at the bottom 5 states by non-current percentage. So in other words, the top 5 states that have the least amount of people who are not current on their mortgages. So Idaho led the pack with only a 1.98% share, followed by Washington, Colorado, California, and Montana, rounding out the top 5 with a 2.39% percentage. So part of the reason why we're not seeing a big increase in foreclosures right now, even though we saw that spike in January, is because a lot of people have equity in their houses, meaning they don't have a negative equity. So here's actually a report I found from CoreLogic. They actually reported this on March 10th of this year. And they say that negative equity, of course, is when someone's underwater, they're upside down on their mortgage, which basically means they owe more on their loan than their home is worth. This data only includes properties with a mortgage. Non-mortgage properties, those that are owned outright and the owner doesn't have a mortgage, are obviously not included in this report here. I wanted to share this report with you guys because it breaks down the states that have the highest share of negative equity and also the states and cities that have the lowest share. And I'll go over that here in just a little bit. It says US homeowners with mortgages, roughly 63% of all properties, have seen their equity increase by a total of over $3.2 trillion since the fourth quarter of 2020, an increase by by 29.3% year over year. Also, in the fourth quarter of 2021, the total number of people who have mortgages on their residential properties who have negative equity only represents 2.1% of all mortgage properties. In other words, 98% of all the mortgages out there have positive equity. In other words, they have equity in their houses, whereas only 2.1% have a negative equity in the US. On a year-over-year basis, negative equity fell by 25%. So of course, the reason why we have only a 2% negative equity share is because home prices have increased greatly, of course. However, they say that if home prices increase by 5%, 141,000 houses would regain equity. In other words, they would move from negative equity to positive equity. In contrast, though, if home prices decline by 5%, 183,000 would fall underwater. According to CoreLogic's forecast, though, they are projecting that home prices will increase 5% from December 2021 to December 2022. This is basically in line with Realtor.com and Redfin as well, but not so much when you talk about the forecast for Zillow. They are forecasting for home prices to increase by 17% this year. We'll have to see who will be right here, but in my opinion, I believe Zillow is very bullish on their housing market forecast. And I think that CoreLogic, Redfin, and Realtor.com are more in line with realistic expectations. Time will tell though, right? So meanwhile, US home prices rose 18% year over year in the fourth quarter of 2021, up from the 8% annual gain recorded in the fourth quarter of 2020. So in other words, we went from a 8% gain year over year to an 18% year over year gain, which is pretty remarkable given the fact that on a historical level, home price gains are in the range of 3 to 5% and not 18%. The appreciation helped push the negative equity figure to its lowest in over a dozen years. Western state homeowners saw the biggest equity gains by dollar value, led by Hawaii, California, and Washington. I found this to be very interesting as well. So negative equity peaked at 26% of mortgage residential properties in the fourth quarter of 2009. That's crazy. 1 out of every 4 mortgages in 2009 didn't have equity in their houses. This is pretty remarkable. When you have a look at negative equity share, though, for the fourth quarter of 2021, here's how it varies by state. So California had one of the lowest shares of negative equity. Only 0.8% of all mortgages in California have negative equity, compared to other states like Oklahoma, 4.1%, Louisiana, 7.2%. So basically, in Louisiana, 7 times more people have negative equity in their houses compared to California. And by the way, home prices rose 18% in 2021, according to CoreLogic, and that's the largest annual gain recorded in its 45-year history, generating a big increase in home equity wealth. And that, of course, is why we have a low share of negative equity and, of course, a low amount of foreclosures as well in the US. CoreLogic also provides homeowner equity data at a metro level. So here's this graphic of 10 metro areas, or 10 of the largest cities in the US. So negative equity has seen a decrease across the country, of course. The San Francisco Bay Area is the least challenged, with negative equity share of all mortgages at 0.6%. LA was 0.7%. Las Vegas 0.9%, in Denver 1.4%. But have a look at Chicago. What's going on with Chicago here? 4.5% compared to less than 1% in Las Vegas, San Francisco, and Los Angeles. In New York, it's 2.7%, Miami 2.3%. So to summarize this report for you guys, CoreLogic began reporting homeowner equity data in the first quarter of 2010. At that time, the equity picture for homeowners was rather bleak in the US. Since then, many homes have regained equity, and the outstanding balance on the majority of the mortgages in this country are now equal to or in positive position when compared to their loan balance. So again, the negative equity share in the US is only 2%, a very low share compared to historical levels. What's your biggest takeaway from today's video? If you got any value out of today's video, then please hit the like button. I greatly appreciate that. And also consider subscribing if you haven't done so already. Hope you have an awesome day. I look forward to seeing you on the next video.